Welcome back to the final episode of our AI in Finance series. Sam, they here.
We are ending this series with algorithmic trading and AI market makers, which is genuinely the wild west of AI in finance. And let me set the stage with some context that most people don't even realize. Somewhere between 60 to 70% of equity market volume already comes from the algorithmic trading. High frequency trading alone accounts for roughly 50% of volume. So when you think that about the stock market, you are really thinking about a system that's already majority of AI and algorithms, not the human traders at all. Welcome to Assemble AI podcast. Today's episode is AI algorithmic trading, the new market makers. Before jump into it, don't forget to subscribe our newsletter in Substacks, Assemble AI. Also, don't forget to subscribe our YouTube channel and Spotify podcast. Share your feedback and also share that what you are learning and also for the topics you want to listen in future. Over to you, Sam.
Thanks, Mac. But let me get this straight. Are you saying that humans are already the minority participants in markets? Which is a strange thing to wrap my head around, to be honest with you. And it seems like the AI is making these algorithms dramatically smarter, faster, and more adaptive than the previous generation of algorithmic trading. Let's talk about what fundamentally differentiates AI algorithmic trading from traditional algorithmic trading. So next time, when you go to your 401k or even like e-trading platform and your AI is predicting something, you can trust that system more than what you're doing right now. Over to you, Mac. I want to see like how these traditional algorithms like follows fixed rules and what kind of perpetuates to move more towards this algorithmic trading and how it can get amplified with AI.
So one of the thing, Sam, that assume that condition X and an action is Y. So if X condition happens, then execute Y action. And it's kind of deterministic and predictable. And AI algorithms...
That's a traditional algorithm, right?
Right.
Yeah.
And AI algorithms learn and adapt dynamically. They recognize complex patterns across multiple variables, adjust their strategies in real time based on the changing market conditions, and optimize those behaviors continuously. So here is a concrete examples. A traditional algorithm might say, if the stock drops 5%, buy 1,000 shares. On the contrary, the AI algorithm says, based on similar historical patterns, current volatility conditions, order book depth, and sentiment analysis across news and social media, determine the optimal entry point, position size, and execution strategy. So you can make an argue like which method will get better. But for me, that it will give me, AI will give me much more faster response and will get much faster results. What I exactly want, because if I know that I want to purchase this particular stock on that day, so at least AI will have the capability. I'm not saying that it will be 100% accurate, but at least it will have the capability to show me a direction, like how the stock is going to perform on that specific day. And I think, and that's actually fascinates me more.
Yeah. Back to your previous remarks, it seems like AI algorithmic trading platform, they're considering more data points here. Like
Right.
sentiment, I feel like they are also considering the qualitative measures of anything like sentimental analysis and stuff, not just going with the quantitative data, which a traditional algorithm does. Like you mentioned, like if X happens, then, predicts Y. So it seems like the previous traditional algorithm is purely reactive and mechanical. But the AI one is that it seems like more predictive and more adaptive because it captures real-time data and it kind of like synthesize and get trained on based on that data. And the amount of data AI can process is orders of magnitude larger. And there is a statistical phenomenon is that the law of large numbers. So more data you pass into AI is going to make it better by in terms of predicting more, systematic patterns in trading system. We are talking about news, sentimental analysis, social media trending, satellite imagery of retail parking lots. In the traditional algorithm system, they're not even thinking about adding those data points. It was not even possible. But AI made it possible to have us process those different set of data points through your trading platform and act on them faster than their other competitors. And it's a massive, I guess I would say, like the leap forward. And I'm pretty sure there are some algorithmic traders out there. There are people listening to this episode are from the stock market. I mean, they would probably understand that AI is literally opening up like a different kind of like opportunity for them where they can consider more predictors to pass into their trading platform, and maybe that will help them to analyze a stock pattern better than they had ever done before.
Absolutely. And if you think in that way, that AI makes market making substantially more efficient and more profitable while taking on less risk. And that's what I was just talking about a few minutes back. So
Yep. Yeah.
better prediction of short-term price movements means market makers can quote tighter spreads, right? And
Hmm?
the difference between their buy and the sell prices while still making money.
Yep.
And what was not even possible a few years back.
Mhm.
And faster response mean like changing market condition, they can adjust their codes in microseconds as volatility changes. So it means more accuracy inventory management, that they're less likely to get stuck holding the positions that move against them. And they profit from smaller margins, but massively higher volume and with better risk management. So what do you think, Sam? What kind of speed are we actually talking about here?
Yeah, the speed advantage is definitely very critical. That being closer by even a few miles can be worth millions of dollars because your orders could move fast on the trading platform.
Mhm.
This creates what feels like an arms race, right? And honestly, it's like probably an arms race between a traditional trader and algorithmic
Right.
traders here. Financial firms are constantly competing to shave nanoseconds of their latency. And regulators are watching this closely because
Uh-huh.
these are
Uh-huh.
legitimate concerns about
Uh-huh.
market stability
Uh-huh.
when AI systems are
Uh-huh.
making the vast majority of trading
Uh-huh.
decisions at
Uh-huh.
speeds no human can possibly monitor or
Uh-huh.
intervene in. It kind of goes back to my previous statement that these human traders could amplify their system, their trading practices to like I would say an exponential level with the advent of AI because they could be able to churn millions and millions of data to find patterns and kind of like bet on that, using their trading system. They don't have to sit down or kind of like spend nights of analysis and do that. So AI making them more AI kind of like augmenting their trading practices here. And that's the part I guess we all need to kind of watch out for because we need to make sure that, okay, AI is doing a lot of stuff, but what are the specific concerns from a market stability standpoint, right? We have seen some flash crashes where market plunge and recover in minutes with no apparent fundamental reason. And we might see that pattern more in future with this algorithmic trading more coming into the limelight as it become more prevalent in the market. I mean, I could share one instance with our listeners here. There was a mini flash crash in 2025 that lasted just 17 minutes, but temporarily wiped billions of dollars of market capitalization. And what happens is cascading AI sell orders triggered by similar pattern recognition across multiple systems, creating a feedback loop where each AI is reaching to others' actions. So it's kind of like the some sort of an I would say agentic stuff happen when one AI agent in the algorithmic trading ecosystem triggers other. And we might have to watch out for those kind of scenarios as we see more algorithmic trading systems getting into the traditional, like the ecosystem of trading platforms and market volatility might get triggered for that.
Yeah, I mean, you actually brought a very nice example, and which are perfectly relevant to these conversations and for our listeners as well. I am also going to talk about a little bit more about the specific AI models that are being used in algorithmic trading. What's actually under the hood of the system? More specifically, reinforcement learning is huge, and AI learns optimal trading strategies through trial and error, right? And essentially learning by trading in simulations and getting feedback on what works. LSTMs for time series prediction, and these are good for finding patterns in sequential data like price movements over time. And increasingly, transformer models adapted for the financial data, the same basic architecture as ChatGPT, but trained on market data instead of human languages. So
Mhm.
there is a point to catch, like that they are trained on the basic architecture that like what ChatGPT has, but they are trained on the market data. So they already have trained on the historical data as well, and that it will give them more accuracy to predict the behavior of the future stocks, right? And I believe that the transformer applications is particularly interesting
Mhm.
because those models are exceptional at finding contextual relationships in data, just like they can understand that banks means different things in river bank versus savings banks. So they can understand that the same price movement means different things in different market contexts. So means high volatility versus low volatility, high volume versus low volume, bull market versus bear market.
Yeah. No, I think you're right on over there because all this transformer architecture that's been, came under the limelight after we got to know about large language model. So
Right.
this LSTM, this feedback loop, helping the AI models to run and get trained in real time. And it's kind of like, I feel like it's just getting to know about the markets in every nanoseconds. So think about it like a human analyst would have
Right.
that capacity to learn every nanosecond of the
Mhm.
market's
Mhm.
status, in a state, volatility, and everything, it'll definitely gonna get better, right?
Right.
And that's what AI is doing because AI doesn't sleep. It can run 24/7.
Absolutely.
So I wanted to kind of take this discussion to a different tangent and kind of want to bring forth that topic of what does the regulatory landscape look like for AI trading? The SEC has requirements for reasonable oversight of trading platform, but defining what reasonable means for AI system that makes millions of decisions per
Mhm.
second is
Mhm.
genuinely challenging. Of course, we need to keep human in the loop. Human traders will definitely have their oversight on the AI trading system. You can't have a human approve every trade when the system is executing thousands per second. Not possible humanly. What would we do? So, what does oversight actually means in practice, right? I mean, in my opinion, this means having switches, having risk limit built into
Right.
the algorithms, having monitoring system that flag unusual patterns, and once it trigger something, then that will send an alert to a human trader and forcing it to kind of like go down. It's like an automatic kill switch that's going to go down or that's going to turn off immediately when you see some unusual pattern that might trigger some volatility in the market. So we
Right.
definitely need to watch out for that. And that's why we need AI specific regulation, which is still evolving, but they need to make sure that even if the technology is moving faster than regulators can fully understand and address it, we still need to put guardrails as soon as possible and as much as possible.
Right. And so more AI trading means more sophisticated strategies incorporating the multi-model data, like
Correct.
more regulatory framework as regulators catch up to the technology. So one final question that is just coming to my mind, that is AI making markets more efficient or more dangerous? And I realize this might be a both or and answer,
Hmm.
because it
Yeah.
absolutely is both,
There's no
because
right and wrong answer to it, to be honest with you.
absolutely. And markets are more efficient in the sense of better price discovery, but prices more accurately reflect available information because AI can process vastly more data than humans, and better liquidity because market makers can quote tighter spreads and handle more volume. But simultaneously more dangerous through complexity and potential for cascading the failures
Hmm.
that humans cannot predict or prevent. So it's time to wrap up the session. Thanks for following our 5-part AI in finance series. We have covered a lot of things: stock prediction, fraud detection, compliance, credit decisions, and algorithmic trading. Each area has enormous potential and real risk. The institutions that get it right will have genuine competitive advantages, and those that get it wrong will face regulatory penalties, reputational damage, and strategic disadvantages. This is Assemble AI. Until next time, keep grinding, keep learning, keep listening. Thank you.
Thank you.